All right, let's work on the income, equity in Marqueen's income, the subsidiary. So let's see, Marqueen earned $100,000, but BuyCo only owns a quarter of it. So they would be accruing in this little increase to the investment subsidiary account. They're $25,000. That would be an increase on the income statement, increase in income. But then that would be reduced by the excess amortization of the fair value over book value for any assets they have. And they tell you that there was a patent, and they tell you that the amortization of the full thing is $40,000, and they've done the math for you and said that only a fourth of that belongs to BuyCo. So that's what would have gone in this slot here. But it reduces the earnings, so it's $25,000 less the 10. But we also have some deferred gross profit here, and that is because they had transactions with each other. And we can't record profits until we sell to an outside unrelated party. So 75% of the gross profit we could recognize because it was sold to somebody else, but the 25% that was sold to each other, from parent to subsidiary or subsidiary to parent, we can't report that yet, not until it gets sold to an outside party. That's GAAP. So we have to calculate the gross profit that is captured on the balance sheet and hasn't been resold yet. So that's the amount of gross profit that is sitting in ending inventory, and we have to remove that and defer it until that inventory is sold in the following year. So how do we do that? Well, the first thing we have to do is estimate what is the gross profit percent, and then we use that percent times whatever ending inventory, if there is any, that's unsold at the end of the year. So let's see, the sales, they tell us that the subsidiary sold to BuyCo for $80,000, okay, and the cost to the seller was $50,000, okay. So then the gross profit on those sales would have been the difference, sales minus cost of goods sold. And what percent is that? So you take the $30,000 and divide it by sales, and you get 37.5%. Okay, so how much of the inventory, how much of the $80,000 is still around at the end of the year? And they tell you $32,000. So we have to take the profit portion out of that. So we have to take that times our gross profit percent. Now, that's for all of the sales, but BuyCo only owns 25%. So be very alert to whether or not you're looking at a 100% or at a 25% number when you're working these problems. So we would want to remove the $3,000 that is BuyCo's portion of the deferred gross profit. And so the income statement would be the $25,000 less the amortization and the deferred gross profit. So we would have $12,000. That would be A, that would be reported in 2015. Now, how will the intra-entity transfer impact 2016? So we defer the gross profit in 2015, and what will happen is that in the following year, so there'll be an ending balance here, ending, and that deferred gross profit will be reversed in the following year. So this $3,000 that's here will be reversed at the following year, because you will be allowed to record the gross profit eventually, just not yet when you sell the amount when you sell this $32,000. And most inventory is sold within a year, except for very specialized industries. So we're going to presume that the inventory will be sold in the next year. So that's how it would impact it. They don't give us enough data for us to do another year, and actually see the math, but whatever was in flips around the next year. We may have to reaccrue another amount if they sell to each other again, and then it'll flip around the next year and so forth. All right, so that is, if BuyCo has sold the inventory to Marqueen instead of the reverse, what would be different? The dollar amount would be the same. When we get into the consolidation chapter, it will change the consolidated net income depending on whether it's the subsidiary that's deferring gross profit or the parent that's deferring gross profit. But we'll get into that in the later chapter, so no need to get too involved. It doesn't change the dollar amount at this point. Okay, ready for the next one.